Today, I want to talk about what I've learned about the importance of valuation. Welcome back everyone, my name's Paul. Now, I'm new to investing and believe me, you should never take anything that I say as gospel. Pretty much every week I learn something new about the stock market. And these videos help me consolidate it into my brain. And hopefully some of the information that I find and the way I explain it might help a couple of other people as well. Because everyone learns differently and this is mainly for people who want to learn in the same way I do. And this week I've learned a lot about valuation. Now I'm not going to go into detail this week about how I value companies. I'm going to save that for like next week or the week after because that's going to be a really long video. But before I start just going out and valuing companies, I need to understand the importance of valuation. And there's no better time to discuss this than right now. Because I don't know if you've noticed, but so many people are making massive gains in the stock market. And lots of experts are talking about how all the companies are completely overvalued, people are paying way too much for them, there's absolutely no underlying fundamentals that are propping these stocks up. And then on the other side, like the YouTubers and all that, they're saying that these companies are going to go much, much further and you should just hold on because it's going to get a hell of a lot better. And to a point, both sides are right. But it's getting a bit out of hand now. And I'm saying this right now in January 2021, but this could go on for years. And it's this article from CNBC this week which I thought was very interesting. The wealthy are investing like a market bubble is here. Or at least near. This is where things are starting to get scary because wealthy people, a lot of the money, are keeping themselves in cash. They're not contributing to things like Tesla and Square and all that sort of stuff. It's mainly the retail investors that are pushing up the prices now. And there's only really been one other time in recent history where things have started to play out like this. And it's the dot-com bubble. I've been doing a lot of reading up today and I've found a few interesting things that you might want to know. The price to earnings ratio of the dot-com bubble was 46.71. That's right at the peak of the dot-com bubble. And at the moment, we're actually nowhere near that. We're only 37 times earnings. I mean, that's still pretty high, don't get me wrong, but we're not at dot-com bubble valuations yet. And believe it or not, this is the main case that's against the bubble. People who believe, or at least tell people that they believe that a stock market bubble isn't coming, use this information as a reason to say, it's not that bad, have a look. Because the PE ratios of the stock market right now are a lot lower than the dot-com bubble. They are. Just keep buying, guys. And what I'm finding in particular on the comments, in the Discord and all that sort of stuff is that people love telling us about how much they're up. They love saying, oh, I'm 400% up on this or I'm 800% up on that. And rather than talking about how good the company is, they're just focused on the price. And in turn, that makes someone else scared about the price. They think, oh, I should be getting that too. And everyone now is trying to find the next Tesla or Amazon. And the trouble is, there aren't many Teslas and Amazons. In fact, there's never been a Tesla. There's never been a company that has gone so overpriced so quickly that stayed there. And SPACs are brilliant for arbitrage. Arbitrage is like a fancy way of saying if you buy something, it will definitely go up. Because if you buy any SPAC right now and it says it's going with an EV company, that price will go up. Everyone is buying it, and if you just go through the YouTube videos, it's all growth stocks, 10x, buy now, best penny stock to buy in 21, time sensitive. Oh my God, that's harsh. Oh, who is like saying, oh, quickly buy now before you miss out? Oh God, that's awful. But it's all like double your money, 10x, and there's thousands and thousands of views. Everyone is just trying to jump on the next big 1000% growth stock. Do we not think this is getting a bit crazy? Because if we go back to the dot-com bubble, we see a full list of IPOs and SPACs that all went bust. Or at least basically went bust. There was loads of them. And right now, there is absolutely nothing to suggest that history will not repeat itself. I haven't seen any solid, concrete evidence that this isn't going to blow up in everyone's faces. Could I do a quick case study with you? Because I found Cisco and the parallels with today's market are so close. Now, in case you didn't know about Cisco, Cisco is a company that I just thought made phones. Every time I've worked in an office, there's been a Cisco phone in front of me and I thought, oh, That company makes the phones. But when you look into it, Cisco is so much bigger than that. Cisco IPO'd in 1990 for $224 million. It was a company that basically invented the internet router. Cisco in 1990 was the company that was going to let everyone access the internet. The internet is the biggest human technological evolution ever in history. Cisco had the routers, it was improving the routers, and its exponential growth on the sales of these routers and how much it was going to change the world was massive. And if we just stop it right there, does that sound familiar to anyone? Cisco's run went on through the 90s. It improved its routers and it was doubling its revenue every single year. It had a huge exponential growth in sales. In 1995, 2.2 billion in revenue. In 1996, 4.1 billion in revenue. 1997, 6.5 billion. 1998, 8.5 billion. This company was growing at a ridiculous rate and is growing at almost exactly the same rate as Tesla. And in March 2000, Cisco was the most valuable company in the world, rated at 569 billion. This is what people were willing to pay for Cisco at this time. They were thinking that the internet's coming, it's going to change the world, its revenues are going to continue to grow forever, which they all did. Cisco had amazing ideas of these routers going into all these businesses. They were eventually going to spread it out. They were going to become the Internet of Things. That was the plan, and according to that time, their CEO was an absolute genius. At the time, the amount of employees Cisco had was increasing rapidly as well. And what was most important is all those employees had shares in the company, much like many Tesla employees do now. And you know what the maddest thing that I did find was what people were saying about Cisco back in 2000. Like this article from March 2000, firm's market cap is climbing to $1 trillion. And all you have to do is read the first sentence. $1 trillion. That's how much at least one analyst believes Cisco systems will be worth in a few years. $1 trillion. Let's take a look at this article from January 2020. Tesla could eventually reach $1 trillion valuation, think tank says. And let's look at the first line of this article. Tesla to $1 trillion. One think tank is toying with the possibility of it being $1 trillion. That's how much one analyst believes that Cisco systems will be worth in a few years. The parallels are absolutely crazy. And I know I'm just picking out Tesla right now, and I have to say, I know Tesla is more than a car company, it's a battery company, it's going to go into all these things, full self-driving, blah, 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 blah. Much like Cisco was more than an internet company. But it wasn't just Cisco that went down, it was Intel and Microsoft, two of the biggest and overvalued companies of the time. And if you invested $1,000 in Cisco stock at the dot-com bubble peak, it would still only be worth $762. That includes dividends it's paid. And I cannot stress enough, this video is not a video about how crap Tesla is. Tesla is not crap. Tesla is one of the most amazing companies in the world, and it will be worth more in 10 years. So stick with me because I fully believe everything that the smart Tesla investor says. And in order to really figure out where we are with Tesla, we need to understand how a company grows. So this is my very poor drawing of what we call the corporate life cycle. We have a monetary amount here that we know what the company is worth, or the amount of money that the company is going to make. That's a very important thing you have to remember, which I don't think a lot of people consider. You have to figure out how much the company is being valued at the moment, as in the market capitalization and the share price, versus how much money the company might actually make. So this line is how much the company will actually earn eventually. How much cash is going to come from it, how much revenue, how much earnings. And this line across the bottom is time. And this could be any amount of time. You could take some companies that have only lasted probably 10 years, like, I don't know, Yahoo, that lasted about 10 years, I think. Or you could take a company like Exxon or AT&T or Tesco, companies that have lasted way over 100 years now. And we have many different stages of the corporate life cycle. This first bit here we call startup or launch. That's a period of time where a company makes very low profit, very low revenues, and the share price doesn't really do much either. And this goes on until we hit some sort of catalyst. There comes a point where the public start using a technology or start really liking a business, kind of like the internet, and people start to use it and start paying for it. After that, we have our exponential growth phase. As one or a couple of members of the public start using a product or service, everyone else starts to jump on it because it's really good. So Netflix is a very good example of this, and Google's a very good example of this. Everyone, as soon as they started getting used to that search engine, everyone used it, and no one has stopped ever since. And that's when a company will see a massive increase in revenue. It'll continue all the way up this line, and then halfway they'll start to reinvest some money, generate new products, span out into new areas, and the growth will continue to go up. When the company reaches a peak, it goes into its maturity phase. That's when sales slow down, competition starts to set in, and growth generally slows. What happens after that is these companies can start to decay, and this happens a lot. Loads of Fortune 500 companies go bust all the time. Think of smoking, drinking, and probably eventually oil. But many of these big companies do try and start a new phase up. They try a reinvest and regrowth phase, which I believe is what the top Tesla investors think that Tesla will continue to do forever. And it's between this exponential growth phase and this reinvestment phase, which is where I try and target my companies. These are the dividend payers that I think will be around forever. Shell is a good example of this. They're trying to reinvent themselves in the renewable market. That's still very much up in the air at the moment, whether they can actually do that. But there are plenty of companies that have done this. Apple and Microsoft are two companies that continually prove that they can keep doing this. And this black line simply represents how much cash a company can generate and how good this company actually is. You can't fake this. This is fair value. And at the moment, this red line represents what Tesla is doing. And I don't think anyone can disagree with this right now. The share price has reached 800 billion very, very early. But actually, Tesla's full worth is worth much, much more than that. And I agree with this completely. Everyone has just jumped the gun a bit. And that's okay. Tesla bears, the true Tesla bears that really don't think Tesla's going anywhere, they think the share price has done this. They think that the share price is now at the maximum amount that the company is ever going to earn. So that would mean that the current share price will not grow any further. But we know it will. We know Tesla's price will eventually, probably in 10 years, be much, much higher than it is right now. Some Tesla investors, and this is why I really love Tesla as a company, but I can't invest in it because of the investors that are already in it. Some Tesla investors who probably don't understand investing and probably don't understand business think that the share price will just continue to go up forever. They think that it goes consolidation up, and it doesn't, and it won't, because that's physically impossible. That's the reason why I can't invest in Tesla, because there's too many people who are invested in Tesla right now that think this. Because we have to discuss what will actually happen to Tesla after this. And if you're a true Tesla bull and you believe that everyone in your Tesla bubble all believes the same thing and that they all have the same strong-willed hands that you do, this is what's going to happen to Tesla's price. At this point, all of the big analysts will all jump on and they'll all start saying that Tesla is great and the share price will never go down. And that should lead to a nice gradual share price rise all the way up until the end. So 10, 20 years later, Tesla's share price matches exactly how much money it's going to earn. If Tesla constantly remains at a 4-year advantage, this is how the share price will go. That's the dream. That's how the Tesla bulls are planning it out. But I can't find a case where that has ever actually happened. But how do you think it usually goes? We have a massive level of what's called exuberance, and then everyone just gets bored. When the Tesla investors who don't quite understand what Tesla actually is all start to get bored and their money doesn't go up at 10, 20, 30% a year, they sell. And then that in turn makes further investors sell, which makes more investors sell, which means all that's left is the guys that want to hold, and they're the ones that understand what Tesla is. And that shouldn't bother those Tesla investors at all, because they know that in 10 years, Tesla is going to be worth way, way more. But if you've got that much conviction on Tesla, you would have bought down here somewhere. You would now currently be up 800 to 1000%. If you're only up, say, 400% right now, you probably got in too late. And believe me, I really do hope that it plays out like this. I don't think anyone wants to lose any money, and I definitely don't want anyone to lose money. But right now, with everybody being so early to the party, and that's what they are, they're early to the party. Companies like Square, Apple, PayPal, CrowdStrike, Roku, even Zoom maybe, they could all still be around for a long time. But right now, investors are early to the party, and that never goes well. Because as we've learned from the internet revolution, investors in 2000 were really early to the party. Everyone knew in 2000 that the internet was going to be this next generational thing and it's going to be amazing. So they betted on the big companies that would bring that revolution. Companies like Cisco. And I want to show you what happened to Cisco over time with its share price in comparison to its earnings. And I want to show you that on a website called FastGrasp because this is just really easy to show you. This orange line right here is all of Cisco's earnings over time. Down here is the year 2000 where the dot-com bubble burst. Cisco didn't have that much in earnings right there. But what we can very easily see is that as the internet revolution took off, Cisco went up in earnings exponentially. Really did. In 2008, during the financial crisis, Cisco started to top out. Cisco started to become a proper mature company, all the way up to today where it's still earning a lot of money. So if we add Cisco's share price over that time, we can start to see the importance of valuation. Because in 2000, Cisco's share price was $65. And after the dot-com bubble, and I would say I do think there's an EV or fintech or just general innovation bubble. Is that what we're going to call it? An innovation bubble? I think I'll just say here, I do understand the importance of disruptive innovation. I think it's very important. But when you push it and market it this hard, when you push it so hard off the edge of a cliff, you end up in a bubble. Does anyone get that? Does anyone agree with me on that? I just think that yes, disruptive innovation is super important and the next big companies are all going to come from genomics, blah, blah, blah. But if you market it this hard, you whip people up into enough of a frenzy, you end up with a bubble. Because people who invest are not smart like you. You probably do sit on YouTube and look through balance sheets and have a look at the future, and you probably understand that Tesla's not a car company, blah, blah, blah. It's going to have loads of cool things in the future. You probably do understand that. But do your peers who have invested the same amount of money as you, do they believe that? Do they know that? And I would bet that the majority of them do not. And they are just chasing the share price. Went on a tangent there, but let's talk about valuation again. So, what I'm looking at here with Cisco's price is what's called a reversion to the mean. Now, in general, over time, a company's share price will track its revenue and will track its earnings. Right here, we're looking at earnings. I would love to look at revenue because I think revenue is much more important, but we'll have to stick with earnings today. How heavy is this getting, guys? Is this getting a bit too much? We've got quite a bit to go. Cisco's price was all the way up here. It came all the way down to $23, which was still above its earnings, and then it stayed flat for 9 years. In 9 years, Cisco's share price made 0.7%. Now, again, not saying this is going to happen to Tesla. We don't know. This time, it could definitely be different. All I'm saying is that throughout history, every single company ever has continued to stick along its earnings. Every company ever. Ever. And I know some people out there think that Tesla is magic, but it's still a business, okay? However, if you caught Cisco below its value, even at $16 right here, over time, you would see a year-on-year annual return of 6.5%, which isn't a lot, considering this company went from the best company in the world, a company that was going to change absolutely everything. It had inventions. It was going to spread out into different markets. It was going to absolutely crush all of its competition. No one could compare to Cisco at that time. And this is where Cisco ended up. Cisco is still, even 20 years on, way below its all-time high. It's still something to think about. Tesla might not be like that. This time it might be different. Blah, 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 blah. And I know I've picked out Tesla there just because it's the biggest one in the market and it's the most popular stock out there at the moment. And I do not believe in any way that Tesla is the company that's at the highest risk of a market crash though. Because this reversion to the mean happens to every company. I've got lots of companies myself that are very much at risk of this. I've got Albemarle that's up 80%. I've got iShares Global Clean Energy that's up 130. It's been way higher than that. I've got KLA that's up 50%. I've got Rio Tinto that's up 47%. Rio Tinto probably should not be this high. And even Walt Disney is a good example of a company that could see a mean reversion. So this is Albemarle. I have a very small position in this company. And what you can see is that Albemarle generally tracks its earnings. Every time that Albemarle dips under, the share price starts to go up and goes up with its earnings. Every time that Albemarle's earnings drop, we start to see a good few years of underperformance. And then we have great news, and we have news of lithium prices going up because the EV market is going to start. This happened between 2015 and 2017, but because its earnings didn't match it, we had a reversion back to the mean. And between the years of 2016 and 2019, 4 years, we had a 28% reversion to the mean. That means that investors that bought at the top in 2016 lost 28% a year. And now, pandemic, EV stocks, YouTubers, hype, we are sending Albemarle back to the moon. But Albemarle's earnings are not keeping up to it. So what's going to happen? What do we think is going to happen? Well, in 2 years, you could probably safely estimate, based on history, that we're going to lose 33%. And this is the sort of thing I'm looking at the moment to see whether I should be selling some of my companies. Microsoft is definitely one that I won't sell. I think I did buy it at a premium, but I bought it at a good premium. I also think this company isn't going to go anywhere for life, and it pays some good dividends. So I should still, even in a market reversion, I should still receive some money. But even Microsoft does the mean reversion over a long period of time. Between the years of 2000 and 2010, Microsoft was minus 2.3% year on year. But once Microsoft dipped under its valuation, we then started to see 20% positive year on year returns. And now the company's just set off, gone to the moon, and I'm expecting a mean reversion very soon. Walt Disney is the same story over and over again. Share price does nothing until the earnings come up. Then when the earnings start to go up, we see a massive rally in price. It's just how the stock market works. However, when good news comes out, like Disney did with its streaming service, things start to change. Things start to get a little bit weird. This is massive overvaluation, and if earnings don't pick up pretty soon, we'll see the mean reversion. That's my prediction anyway. And just for giggles, this is what Tesla's price to earnings look like. Where do we see it going? Where do we see Tesla going? Where do we get to the point where Tesla crosses over with its gains? Is it down here, or is it more across over here? I honestly don't know. This is just the theory and the learning that I've been doing recently. Legacy dividend payers like AT&T do this too. 2000, AT&T did not meet its earnings. Straight down. Again, earnings start to pick up. Investors get really happy and the price goes too far the wrong way. And we end up with another classic mean reversion. But with AT&T right now, maybe, just maybe, we see it in a different way. Earnings are continuing to rise, but the share price is very, very low. This is because there's a lot of bad news about AT&T, there's a lot of management questions, people are worried. However, when earnings start to recover, share prices generally revert to the mean. So just based on this information, could we think that AT&T now has a 23% upside within 2 years? Possibly. I don't know. Obviously, you don't act upon this information just on its own. Same with Tesla. You wouldn't just act upon that information on its own. If Tesla brought out a bomb that killed all other automakers, it killed all other battery makers, and it killed, I don't know, Mobileye, then yes, maybe Tesla does deserve its valuation. But are we a little bit too early? And then we have some companies that do still follow this rule, but they always trade at a slight premium, like Coca-Cola. Coca-Cola, year 2000, did nothing until 2009. For well-established companies like Coca-Cola who are just trundling along, you might like to follow their normal PE line. Because again, we do see similar mean reversions, but they just happen at a premium. And Coca-Cola right now is sitting right on top of its normal PE line. Coca-Cola is, again, overvalued right now. But because it's such a safe company, it always trades overvalued. Maybe this is a positive fundamental case for Tesla. Even Apple does not get away with it. We see constant mean reversions all the way up its share price. Every time its earnings take a little slump, its share price dumps. And now, over exuberance, hype, all in tech stocks, people are just flooding into it. How long do we seriously believe that this will go on for? And I'll tell you, this could go on for ages. The Cisco share price went on from 1995 all the way to the year 2000. 5 years. 5 years this went on. So Tesla's share price could now continue, could now continue all the way up for another 5 years. I mean, what's that, like 5,000%? 5,000% you could see before it starts to revert. And this is what my full problem is. I have no problem with Elon Musk. I have no problem with Tesla as a company. Everything the bulls say about Tesla is completely true. Tesla will be worth much more in the future. It's an excellent car company. It's an excellent not a car company. It's going to rule self-driving. It's going to probably rule energy. But, and this is a big but, when Elon Musk decides to tweet out about a messaging app and the completely wrong company goes up 5,000%, that's why I don't want to invest in Tesla. Because we've got too many investors in Tesla right now that are attached to the price and they are attached to making quick money. That is why I'm not willing to say that it will happen, but I'm not willing to take the risk on buying Tesla right now. And now that I've just done an entire video talking about value, talking about FOMO, and talking about buying things that are way, way overvalued, I'm going to talk about Bitcoin. Because Bitcoin is also something that has definitely not realized its true value yet. I'm invested in both Bitcoin and Ethereum, and I'm largely attempting to sort of trade these at the moment. Ethereum, I'm over 100% up. I know it says 2.37%, but that's because I took a sale to consolidate all my Ethereum the other day. And Bitcoin I kept all separate. I only have a very small amount of Bitcoin and Ethereum compared to my overall net worth. Bitcoin and Ethereum are two commodities where their price is based solely around this stupid human behavior. The difference though between these cryptocurrencies and Tesla is that in Bitcoin people aren't joking themselves about how much Tesla or how much Bitcoin is worth. Bitcoin and Ethereum prices are solely based on human stupid behavior and the stupid behavior of fear of missing out. And for me, when this human behavior is isolated in this way, it's rather rational and rather predictable. So I'm currently in Bitcoin and Ethereum, not because tomorrow I think people are going to start using Bitcoin as a currency, but because very far in the future I think it probably will be, but I'm willing to take the volatility, and I'm also willing to make a lot of predictions based on stupid human behavior. So I've taken a look at this graph. This is the graph of Bitcoin after all of the halvings, and they all follow a very similar trend. They all have a very large bull run, they all have a few pullbacks, but they all eventually culminate in one very large bear market. When you scale all these halvings together, they all reach a similar price. And this very slim blue line up the middle here is today's price. So if we are to look at Bitcoin from an anthropological view, we might be able to determine that Bitcoin still has quite a way to go. It still could reach 100,000. And to be honest with you, that's kind of the area I'm targeting. I may take some profit at that point. I may even sell. But on the other hand, I'm a big believer of Bitcoin and Ethereum. So even if this price does tank 90%, I'm actually very comfortable with sitting on Bitcoin for much, much longer than this. And that's ultimately what we have to think about. That's ultimately what this video is all about. It's all about risk. It's all about accepting that if you buy at such high valuations, you might lose all of that money. Or if you take the case of Cisco, you might lose all of your money for at least 20 years. And as long as you completely understand that risk, fill your boots. Okay, I'm just going to finish it off with a quick question asked to me on Instagram today. @life121 says, awesome vid, thank you. Quick question regarding your investing dividends in order to compound interest over time. Do you reinvest your dividend back into the company that paid it out, or do you take a company's dividend payout and reinvest it elsewhere in your portfolio? Today's been a very good day. There's been a lot of dividends paid by Trading 212. So I'm going to have a lot of dividend reinvestment happening soon. And if you take a normal DRIP program, a DRIP program, often your broker will just reinvest your dividend back into the same company. Now, I don't personally do that specifically because, again, I'm looking at value. I am a big proponent of cost averaging. I think that time in the market beats timing the market on all cases. However, I wouldn't feel as comfortable as investing as much money into KLA as I would into, say, Lennar. KLA is another great example of mean reversion and overexuberance. KLA's a semiconductor inspection company, owns like 80% of its market. It's a very, very strong company and one of my favorite picks since May, I think. But as you can see, tech revolution all the way down 7% a year. And now as its earnings have started to increase and it's seeing exponential growth, its earnings have gone up quite considerably. However, again, pandemic is just smashing this company to the ceiling. However, if I'm going to look at Lennar Corp, I think Lennar Corp has a very good couple of years ahead of it. It's in the housing sector, it builds homes, housing inventory in the US is very, very low, and that's my idea around Lennar Corp. I think it's going to do very, very well. So I would probably prefer if my dividends from KLA did go into something that's got less value at the minute. Thank you very much for watching, guys. The investment app that I use is called Trading 212. If you wanted to get into investing, you can sign up through a link in the description below. If you sign up through that link, you get a free share that's worth up to £100. Also, I buy my Bitcoin on eToro. Please remember though that cryptocurrencies are extremely volatile and your assets are at risk. Also, don't forget to check out the completely free Discord. Right now we have a new pet section where everyone's putting photos of their dog up. Probably nothing to do with investing, but this is the sort of community that we're building up now. I think it's really cool. And obviously that's a separate channel. You go into the stocks channel and everyone is banging on about stocks in there. There's loads of people who really know their investments. We're all talking about Trading 212, talking about Bitcoin, everything like that. It's an absolutely brilliant chat room full of information and it's completely free. And if you feel like it, you can follow me on Instagram where I recently showed off my draft thumbnails for my last video with Mama Fuffa. Her mouth with my eyes and her eyes with my mouth. Absolutely freaky. But on the Instagram, I talk about all the new trades I make, every time I buy something, every time I sell something, if I do. And I also post up random stuff about my life. Thank you again for watching, everybody. And if you enjoyed this video, please feel free to give it a like, subscribe, and invest.